All right, good evening, guys. Ken at Tortoise Capital. This is a mini masterclass on some basic math that we use. There were some questions this weekend. So the first idea I want to talk about is the is getting the drawing pad connected to make it work. There we go. What do you know? Is the RL10 as the trader's price. So a regression line is the best fit line for a set of data. So if I have 10 data points where price is closed, something like this, the best single line that describes that is a regression line. And what that does is it's the line that minimizes the amount of error from each individual data point, like this one, and where the line is drawn in that time frame. So the red line minimizes the average distances of all those points to the line. So it's computed mathematically. So one way to think of that in descriptive statistics is that the perfect price is the spot on the red line for that time period, and there's a certain amount of error where each price was actually printed. So one of the ways that we can then compare lines, all other things being equal, is, let's say I had I had data that looked like this, and then other data that looked really tight on the line. Now, the regression line on both of those data sets is identical. In this case, it's a slope of 0, meaning that it's flat, that the start point and the end point are about the same. Right. But the lower data set is a lot more tightly clustered around the regression line than data set A. So data set B is much more tightly clustered. So the line at B is a better descriptor, is closer to the truth. There's less error. So this also works if you've got a slope of that line too. So one of the things we take a look at is we say, look, if you had a perfectly flat line with a slope of 0, and then the regression line that captures the price has some angle, whatever it is, theta, the amount of the number of degrees that you have, this would be 0 degrees, this would be some kind of x degrees. The sharper up the slope, the stronger the trend tends to be. So one of the things we like to do is we compute the last 180 days. So let's go, and then we're going to compute the RL10 for each one of these data points, right? So on day 171, wherever those 10 points were, on day 171 to day 180, we could compute that and then figure out what the angle of the slope was and record that. On day 171, the slope had a value of this. And then the next day we would go 170 to 179 and we would compute the slope. And so you have this, by the time you're done, 180 different values of the steepness of those lines. And then we can rank that by max, min, average, and then compute the standard deviation of that to see how much variation there was day to day in the slope. How much was that oscillator wiggling, or the speedometer? That's a good way to think of that. So all of the things being equal, we could think of all of the values in that look-back period where the Z-score was between plus or minus 1. We would just think of that as a normal slope. And then anything where it was more than one standard deviation above average, we would call that some kind of positive or abnormal to the abnormal strength. And anything below that would be abnormal negative. That you would have some kind of exceptional condition today. If today it got steep enough that it became positively abnormal, then you would have reason to declare that maybe there's something special going on in here today. There must be something special about this day because it just tipped up into abnormal. So you could actually think of us having a little speedometer on the side with +1 and -1 and 0 on the Z-score, and that each day we're plotting that and calculating a Z-score, and we can determine at a glance how strong is that market's move today compared to the most recent history. And I like to go back 180 days so that I can get a real feel for the maximum and the minimum, some of those larger trends. So we call that the Slopestat. And it's simply built off the idea that straight line, 10-period regression line, is a reasonable smoothing of price. It gives us a normalized price. Now, one of the other things that it'll do is it allows us to describe what tomorrow's perfect price would be. In Excel, it's using the forecast function. And there's really two ways to do it. Let's see. So if I had 10 days of data in here, what I could do is I could project that line forward and say, now, if tomorrow behaves perfectly according to the rational description of the line, then we would forecast the perfect price to be there. Now, why would it show up exactly right there? The hypothesis is that there's some kind of underlying black box of actions that are going on in the market. It's churning around in there, and what it's doing is it's having an impact on price. The market action and the price action and all the participants and all the news and the buying and the selling and the seasons and all that is making price move. Well, if we predicted that tomorrow the perfect price would be there, and then it actually ended up right there, we would be able to then look back and say, well, apparently there was no significant change in the underlying market conditions in aggregate, or the pluses and the minuses perfectly balanced, and it produced exactly the predicted mark. So no significant change in the underlying market day to day. Well, on the other hand, we said, well, what if it wasn't quite perfect? What if it wasn't quite perfect? What if instead on the black line it went up as far as this orange dot, or maybe this green dot, or maybe this blue dot? With that kind of logic, we might say, how far away from the perfect rational price does price have to go before we can make a claim that something significant just happened down here? So this gets us into the idea of signal versus noise. And in regression theory, it has to do with the size of the error, the size of the standard error in those prices. What we can say is that when you take the average distance away from that regression line, that's going to equal a standard estimate, a standard error of the estimate. So we'll just call it one standard error. It works something like a standard deviation does. The math is similar. And in fact, if we have two standard errors, that gives us a 95% confidence interval, that tomorrow's price would be inside of that if nothing changed. So one of the things we can do is we can take the position that this little blue dot, I guess I should make that different. Let's make that the little yellow dot, is the perfect price. And then based on this average error, or the average distance from each of the points to the line, we might set up a threshold and say, if tomorrow's price actually ends up somewhere in the shaded red area, then the amount of error is insignificant. But if it comes outside of that, we would say, that was beyond the standard error, and so there must have been some kind of underlying change that was significant in the market, and that is a signal of a directional move, whereas any price action inside this red region would just be noise. It helps us create a mathematical definition of signal versus noise. Now, I want you to notice that what this lets us do is take some array of price on the day when price is open, and if we know what that standard forecasted price is, we can start from that point and go outward and decide at what point does it become signal and when is it noise. Now this works kind of in the same way that Bollinger Bands do, with the following caveat, right? So when prices are moving around, what Bollinger Bands do is computes the envelope today. We'll make this a black line. It says that when it looks back, it finds that in the case of one standard deviation, it will say that 2/3 of the data was between the average of, from the high to low, it computes the average. It'll say that 2/3 of the data was contained within plus or minus 1, about 95% between plus or minus 2. And what it's doing is it's simply looking back in here and say, where was the data expressed, and how wide do I have to make the bands in order to contain all of the price action, or that portion of the price action. So Bollinger Bands start with an outside envelope and say normal is going to be contained anywhere within these brackets. So normal is anywhere within those brackets, and when it breaks out, it's signal, or it's an extreme move. Whereas the regression line starts with a single point and then works outward from a single point and says, if it gets outside of that threshold, now you have a signal. So they're very closely related. And they give us a way to make a mathematically precise definition of the difference between signal and noise. Where does that appear in our normal trader's mind? In the normal trader's mind, they look at breakouts as some kind of significant move, and that makes certain good sense. I mean, so do we. If we think about the patterns of the Z3 pinch and the super pinch, what we've done in that specific case is we've said that the Z3 lines are going to narrow all the way in here. Well, what happened way back here? Well, way back here, there had to have been some kind of large directional price action that stretched the boundaries of the Bollinger Bands in order to capture the width of that price, or the height, if you will. But now when price starts oscillating and starting to compress along a single narrow channel, now suddenly the Bollinger Bands compress because, like right here, most of the price action was contained in that space, so you could draw the Bollinger Bands here. When you get way up in here, the price had so little variation that you could compress the size of that envelope to here. So what we end up doing is comparing the width of the Bollinger Bands, and we're able to say, look, this is really volatile because of the width of the Bollinger Bands, and this is normal because of the width of the Bollinger Bands, and then this is very, very quiet because of the compression of the Bollinger Bands. So what we're looking for in the Bollinger Bands is extreme volatility on the upside or on the downside. The absence of volatility makes it special. Where you get chewed up is if you're inside the river under normal conditions, because the oscillations are not long enough for you to get a tradable price, because you're trying to trade some oscillation and you're waiting to see it move off that bottom a certain distance, and so you get your entry. But when those oscillations compress and then you end up taking your exit off the top, now suddenly what's left in the middle is no longer large enough. Your reward is no longer large enough to account for the stuff that you're given back. Whereas when you have really large moves, and you have small risk boxes, and you're only given back a small risk box on either end, you're capturing that whole move here in the middle. So under periods of great volatility, you can actually play the turning point and play to the other side. But there's not enough room inside the narrowing Bollinger Band to do that. However, when it compresses so much, what you're no longer doing is trading inside the bands, but you're waiting for the breakouts from the bands. Now, when you get either a breakout to the upside or a breakout to the downside, you can put your standard risk box here, and then this thing will go with your trailing box here, or it'll go this way with a trailing stop that way. And so you're using the absence of volatility as your sign. That is what it's signaling you, that there's an abnormal amount of no volatility, an abnormally small amount of volatility. So for us, it's important to be able to use these kind of mathematical concepts so that we can have very precise definitions of normal and abnormal. And because we are using typically 30 days or 30 bars of look back, 30 bars, we drop off the oldest one and add the newest one. We're constantly getting an adaptation and an adjustment going forward, so that the 30 days of very volatile markets is appropriate when you're taking a reading in here. In here, you want your standard deviations and your boundaries to be driven by the fact that it's very volatile. But when you're up in here and the last 30 days have been very tightly compressed, you want to make sure that your definitions of volatile and normal and abnormal, quiet, are very responsive to changes in the market conditions. And so that's why we think that having a basic understanding of simple math like this is an important way to give you a persistent edge in the market for people who don't recognize the rate of change with which markets change their volatility characteristics. Okay, so that's what I wanted to say about the R10 and Bollinger Band, signal and noise. And the final point I want to make is that we're using the forecasting function when we're estimating what tomorrow's price might be. But we're not predicting that that's where it will go or it must go. We're simply using that as a reference point, on the price line. So here's today's bar, and if that's where the perfect price should be, and it opens here and starts moving up, we can start determining based on how far away from the perfect price it is this becoming an abnormal up move or an abnormal down move, or is it still within the boundary of expected variation, or it's just within the noise. And the fact that we're using adaptive descriptive statistics gives us the ability to have a very precise, consistent, and disciplined indicator when it comes to that. Okay, so that's everything I wanted to cover on basic math for today.